purpose of this panel is to affirm our time horizon and think longer term about our portfolios. The world's kind of crazy right now. Chaos abounds every direction that we look. The best we can do to manage that is withdraw from the headlines and think longer term about our money and about our life. So I'm going to go down the line. Mark, I'd like to start with you. If you could speculate the ideal portfolio performance, like what would be in it right now that you would be pretty comfortable is going to be okay or up in 2030? As diversified as you want to take it.
If I had to buy it now and let it sit for 6 years, whatever. First of all, long-term perspective, that's the way that we make money. Charlie Munger said the big money is not made in the buying and the selling, but in the waiting. So you got to wait for the right opportunity, and then you have to wait for it to develop. So that's the right outlook. So 2030. I project that this decade will be inflation. I'm an inflation bull for the decade, driven by deglobalization, or as I call it, decentralization. I think we continue to have a loss of trust, and so we continue to see the end of the international monetary order, or the fiat system as we know it, and that's sort of a shift back to hard assets. So I think we're having a commodity bull run. I think we see a loss of trust, and I see lots of inflation and lots of money printing and lots of debt addition. So the portfolio for me would be one, commodities. So I like those. I like energy intensive commodities. Yes, I like gold. The other commodity I like the best, of course, is Bitcoin. So for me, it's going to be probably way over allocation to Bitcoin for most people. A little bit of gold. I think gold is probably the interim step that central banks try to go to restore a little bit of trust in the currency. And that's sort of this interim step. So I think that's probably good for the next couple of years, so we'll put a little bit of that in there. The COP28 just met a few weeks ago, and they went from wind and solar to now nuclear is our #1 initiative. We want to triple the amount of nuclear, so of course uranium is going to make a big percentage of that as well. And then I think energy, right? So no matter how much wind and solar they want to pump down our throats, and now we add uranium, we're still going to need oil and gas. So we're going to go with probably a huge allocation towards Bitcoin, because it's a more scarce asset. It's very energy intensive. We're gonna put a little bit of gold in there for that little pump. We're gonna put some energy plays, oil and gas, and some uranium.
Okay,
is that so what you're looking for?
Yeah, you nailed it. So Bitcoin, gold, energy, and uranium. I know you're a big real estate investor as well, Mark. Real estate factor into that portfolio?
Yeah. So real estate, I use that for offsetting taxes. I also use it for cash flow, and I also like cool places. So real estate is a good place for that. So certainly that makes up a pretty big chunk of my portfolio. Again, back to scarce assets. If we just kind of break this down real quickly, I'm an inflation bull. So I think the problem that most of us are going to have is we're not going to be long enough for what's coming over the next couple of years for the rest of the decade. And so in order to not just keep up with inflation, the S&P does really good with that. But in order to beat inflation, we need to be in scarce assets. So those would be fine art, collectibles, things like that. Bitcoin, of course, is very scarce, energy intensive, but also real estate. But not just real estate. Real estate's a perfect proxy for inflation, but beachfront, waterfront, lakefront property. So certainly I have some waterfront property that I'm working on, so we'll be adding that as well.
The antithesis of inflation, anything that can't be created easily. That's the play. All right, Grant, over to you.
Like Mark, I think inflation is going to be the problem we have to mitigate in the next 6 years now, 7 years now. So I can't argue with much of that. I wouldn't have as big an allocation to Bitcoin, obviously, but I would take some of that Bitcoin, and I talked about this a couple of times recently. Japan. I think Japan is going to be a place where you can make some really, really good money in the next few years. It's been off everybody's radar for 25 years. I'm biased because I began my career in Japan in the mid-1980s when it was the hottest market on earth. And it's been in pretty much a bear market for the last 25 years. And so it's amazing that the world's third or fourth largest economy is just off everybody's radar, but it has been. And for good reason. There's been nothing to get excited about in Japan, but very slowly, over the last sort of 7 or 8 years, there's been an incredible shift in corporate governance. The companies down there have been forced to get their balance sheets in pristine condition. I mean, you go down to Japan, you can find world-class companies trading below book values, single-digit PEs, returning money to shareholders, better corporate governance. It's extraordinary. And I think Japan is going to be a really good market. We've got the Nikkei finally approaching, finally ready to take out its all-time highs, which it made in 1989. So that just shows you. You think how many new all-time highs the US stock market, for example, has made, Japan hasn't made one since 1989. So I think Japan is something that a lot of people are going to look at. I think the real estate component is important if you have it already, but I wouldn't want to be buying it now to put away for the next 7 years. I think commercial real estate particularly is going to come under a lot of pressure in the next 2 or 3 years. I think there'll be a great opportunity, but it's not yet. I think the housing market similarly. I think prices haven't corrected to reflect the increase in mortgage costs, and if the Fed can't lower rates and keep them down, then I think the people who've been hanging on and dipping into their savings to pay their heightened mortgage payments are going to cry uncle, and I think we'll see another fall in the housing market. But other than that, gold, I agree with. Obviously, I'm a big proponent of owning gold in the portfolio. Energy, I think, is not going anywhere anytime soon. I think the green agenda is beginning to fade pretty quickly now. And I think people are starting to realize that we cannot survive without fossil fuels. It's a great idea to be green, but mandating we're going to be green by 2030 is just a pipe dream. So that'd be my big shift from what Mark said. I wouldn't have as much allocated to Bitcoin. I'd probably have a bit just for fun, just because it'll shut people like Mark up from trying to convert me. So I'd have a bigger allocation to gold. But otherwise, yeah, I think everything you said, I would agree with 100%.
Gold, energy, and Grant,
Japan. Don't forget Japan.
Gold, energy, and Japan. Could I get you to drill in just a little bit to the energy component? Whereabouts are you looking exactly?
I just want to own exposure to natural gas and oil. And some of it's going to be the midstream companies. There's some terrific midstream companies, and a lot of that might be, MLPs are, I think at some point will be a good buy. Not right now, but I think MLPs will be a good thing to buy. But I just want exposure to that because I think there's going to be a U-turn, and I think people are going to start opening up drilling rather than closing it down.
And complete agreement on the inflation thesis, sounds like.
That's the problem. That's the biggest problem I feel I'm going to have to face. I could be wrong, but that's where my focus is.
No, okay, awesome. Thank you, Grant. Matthew, over to you.
Well, listen, I absolutely agree with both things that I know from talking to Rick this morning. We're all going to probably say the same thing about inflation. I see there's no way around negative real rates over the next 6 to 7 years. So another higher inflation is inevitable because we're going to have to print our way out, inflate our way out of the debt crisis. We have a debt crisis, we have a credit crisis, and then so if there's a bond crisis and a debt crisis, there's going to be a currency crisis, there's going to be a debasement. So I want allocation to hard assets. Obviously, I'm very biased towards precious metals, less towards Bitcoin, not anti-Bitcoin, but for the type of portfolio that I would want, it's going to be more weighted towards precious metals in general and gold in particular. Perversely, I think when we have rate cuts inevitable and more inflation, equities could continue to have a tailwind. We have to keep in mind we're looking 7 years out, not the next 6 weeks, but the irony is with equities in an inflationary scenario, then it's okay, how do you pick those equities? And I would stay away from the version of the Magnificent Seven right now. I think they're massively overvalued and they will continue to be. I would look for better value. I was reading the other day about something, the current S&P is trading at 7.5 times the global equity index. So we're trading 7.5 times greater than we already are in the rest of the world stock markets. And yet that can still go higher, especially in the next 10 to 24 months if we do get the rate cuts that I foresee and projected. So I would look for value. I do think there's going to be more reshoring. Not just make America great again, but there's going to be reshoring of manufacturing, which we've outsourced really for decades. America's going to have to make a choice, Canada too, to reshore manufacturing. We've outsourced the American dream to China since 2000. And so I think there's an opportunity there to pick good industrials. Like Lou Groman, I see a good play in even the infrastructure for electricity. That's certainly with the Bitcoin, so that would be necessary, but for other reasons too. So I would definitely have that type of allocation, definitely with inflation in mind. And also keep in mind, and this is the former naive hedge fund manager of the dot-com era, and the things I learned in the dot-com lottery ticket win I had on IPOs, and another thing I learned in the crisis in 2008. It's not just what your sexy stock, your sexy sector, your sexy pick's going to be, lucky or intelligent. It's how you manage that portfolio. And the one thing, when I hit that lottery ticket, was a family office guy, and then merged with other family offices. There was always a debate about what's your goal. Is it keep beating Jeremy Siegel's 8%, keep beating inflation, return. At a certain point, depending on where you are in the spectrum, it's also preserve, protect. So you got to think about what's your goal. I'm not against speculation. I'm not against reaching for more return or yield, but it's going to be a dangerous world to find yield on that risk branch. You got to be careful. So the lesson I learned from allocating to much better portfolio managers than I was, The three biggest risks, I think, in a portfolio is over-concentration, and whatever that asset is, no matter what you're biased, there's a massive risk and concentration risk. Leverage is a major risk. Be careful of your own use or your manager's use or your expert's use of leverage. And timing risk. I know we're trying to project 7 years out, but it's very hard to time a move. And so you want to have a portfolio that, addresses those key risks. So it's not just what, it's also how. But clearly, the inflation theme is on our mind. I want assets that can't be created out of thin air, basically, and can't be manufactured out of nothing. And, as a European American, and the stories of World War II and the grandparents and their grandparents, even before I even understood protection and understood preservation as a key goal, it was always gold, land, art. It's kind of a joke in Switzerland, but it's actually not so funny now. And I think there's other things we can think about as assets that can't be manufactured willy-nilly.
No, I love the simplicity, man. Steak and push-ups. That's what I say. Keep it simple. On the reshoring trend, though, pulling American operations out of China, where do you see those going? I mean, to the U.S. doesn't make a lot of financial sense. So is Mexico the big winner? What's your take there?
This is something Danielle DiMartino Booth came up with. I listened to her a few days ago, and we were talking about this, but I think she's right. In terms of reshoring or other opportunities in emerging markets or outside of the U.S., demographically speaking, once we get past a global recession, countries like Mexico, India, they have a great demographics. So there's going to be opportunities there. Again, you'll have to wait and see where the signposts are, but in general, we got to be looking outside the U.S. But I also think, I grew up in Michigan before I went set off to Germany and before I married a French woman. But, I'm a patriot. I'm a Midwesterner. It's simple, stupid, but I've seen what happened in the Rust Belt, they call it. My grandfather worked at Ford. I saw what happened to Detroit, to Flint, the Midwest in general. I do think it's not only morally and professionally and nationally essential, I think it's economically essential that, when we outsource the American dream in 2000, 2001 under Clinton, that we bring those jobs back. I think it still has to happen in America. I think whoever's in power, left or right, red or blue, or anything in between, it's pretty axiomatic that you can't have GDP without without production. And I'd like to see that actually come back instead of just being a service economy that inflates its debt away with a bogus currency.
Now, is that an inflation driver, though? Because costs have to come up, paying American workers versus Mexican, Chinese, Indian, et cetera.
Yeah. Certainly, inflation drivers are going to be, to me, that's the Milton Friedman school. Inflation, to me, is ultimately about money supply. It's ultimately about currency. And it's about whatever we call our currency. Yep. I don't see a gold-backed U.S. dollar in the next 7 years. I just see a very different understanding of the value of that fiat peso, yuan, U.S., Canadian, Australian dollar. So again, when you're measuring your portfolio with a 20% return or an extra million or an extra 100 or an extra 1,000, it won't buy as much in 7 years as it does today, and it certainly doesn't buy as much as it did 7, 10 years ago before.
Yeah.
And I'm not trying to be flippant. I'm not. $1 million isn't what it used to be when that was the goal, to be a millionaire.
For sure.
And sadly, that's, not again trying to be flippant, but that's a sad world where $1 million isn't really much anymore. And yet, it's very important to think about that.
Yeah, thank you, Matthew. Rick, same question, over to you. Portfolio building today, 2030. They changed it. They changed it.
Be a hell of a
for
lot
us
easier if
for
you
that.
could be Outlook 2023. That'd be a lot easier.
Hindsight.
Yeah, okay. I think, by extension, what people should invest in is themselves. People need to invest in their own education. When you talk about the whole panoply of risks out there, I think the most egregious risk that any of you face is located to the left of your right ear and the right of your left ear. There's a whole bunch of risks out there that scare the hell out of you that you can't do anything about. So I would suggest that you work on yourself before you worry too much about Trudeau or Biden or Trump, no matter how problematic they might be. I agree with these gentlemen that inflation seems to me to be the biggest macro risk in front of me. I also believe that there's a chance of a liquidity crunch, a recession, something like that. I'm not saying it's going to happen. I'm not smart enough to tell you. But I'm governing my own life being fairly cautious. In sectors anymore, I'm 70 years of age. I only do stuff I understand. So I understand conventional financial services. I'm building a bank. I like the community banks. Nobody else likes them, which is one of the reasons why I do. It's a good business, and they're stupidly cheap. I like property and casualty insurance. Again, it's a good business. Everybody hates it. So it's very, very, very cheap. If I had to pick one sector, perhaps because I know it well, but also because I like it, it's conventional energy. The big thinkers of the world tell you that peak oil demand is going to occur in 2030. I have no idea how these guys are going to fly all their private jets to Davos to tell you to drive less with no oil, but they think they're going to. And North American natural gas is cheaper yet. And you don't have to go way down the quality trail. You can do the Devons, you can do the Equitables, you can do high quality companies with 6 or 7% yields in a commodity that only can go up. If we have a recession, Jay, and I'm not saying we will, I'll leave that to the acro guys. You know, I'm just a used money salesman. But if we have a recession and the whole commodity complex comes off a fair bit, then you can buy with impunity the Glencores, the BHPs, the Rios, the integrated major companies. And if you have the guts in a recession, you can buy the penny dreadfuls with absolute impunity. I'm not saying you're going to have a recession, but if we do, come through this floor here, pick people who've been successful before, and just absolutely, positively fill your boots. People who know me know I love hate, and I think there's going to be a lot of hate in this decade. There's going to be a lot of stuff not to like. What don't people like now? People hate Africa. Great resources, great demographics, an exploding middle class, human resources that people don't understand till they've been there. So I'm looking at Africa very, very carefully, both because it has fantastic potential and because people hate it. There's actually young folks in Africa. You know, the population doesn't look like us, damn near dead. What else do people hate? Oh, they hate Muslims. So I like the Middle East and North Africa. For geology, I like that whole belt of rocks that goes from Turkey to Mongolia. I like it because it has great prospectivity, but I like it more because, you know, people say this, well, like they make these really intelligent investment decisions like Muslims are icky people. There's nothing I like more than ignorant hatred. And when people look at the Middle East, they're expressing the most vile form of ignorant hatred for a place that has lots and lots and lots of upside. That probably turned off the whole audience, but if it didn't, I have one more idea. I love water. Bad pun, it's an illiquid asset. I've been investing in it for 35 years. I continue to buy very high quality American farmland, despite the fact that it's no longer cheap, where I can get in situ water rights. The price arbitrage in water between government-controlled water, which I think will soon become available, and the utility of water in a broad market is the single dumbest commodity arbitrage on the planet. That doesn't play very well in Vancouver, where your challenge is to make water go away. But in other parts of the world where water is scarce and where people can afford it, I would suggest to you that the single greatest price arbitrage on the planet, other than monetizing stupidity, is in water.
I love that, Rick. Okay, thank you, and great perspective. So I'm going to pull on the demographic bullet points on Africa. Demographics often lead, right? When it comes to emerging nations, does anywhere stand out to you guys, right? India, another country with some of the best demographics in the world. Most superpowers, powerful countries, are facing massive demographic challenges. There's a few that aren't, but they're not the powerful countries. Generally speaking, do any stand out to you on emerging markets that you're most bullish on? Matthew, maybe I'll start with you and then work our way back.
Well, again, as I mentioned, the two that stick out are Mexico and India in particular. And again, not too loved all the time in the media and misunderstood.
And is that based on demographics and something else, or what are you looking at?
Well, just the age of the population, right? Who's going to be the buyers? Who's going to be phasing out? You know, and I know that there's been some cryptic comments about even in the U.S. There's massive amounts of baby boomers with massive amounts of money that if theoretically, if they were to die at the right time in the next 4 years, that would be a huge wealth transfer to the second generation, which is much younger. They'd spend, there'd be more productivity. That's a dark thought. It won't happen. I mean, I'm just saying, the idea of the young and aged, the working, the availability. But the other problem with Mexico is you have political problems and you have cartel problems, and in India you've got poverty problems and environmental problems. So it's not just black and white, easy demographics. There's other forces at play, and there's the known and the unknown, the black swans, the gray swans, and the white swans that we can kind of have to speculate upon. But I think the larger theme of a more global or less global world will depend on politics, geopolitics, and centralization and understanding. I think that's the fourth thing that, I'm not trying to change the subject away from demographics, but when I talk about the domino effect, when you have debt, then you have a debt crisis, then you have a bond crisis, then you have a currency crisis. But the fourth thing you have, without exception throughout history, is centralization crisis. That means extreme political reactions from the left to the right, whether that's lockdown, censorship, weaponized currencies, weaponized media, weaponized science, et cetera, weaponized Department of Justice, et cetera. Pick your argument, pick your bias. I see that as another force. That can be nationalism, that can be protectivism, that can be tariffs, that can be other things. In addition to demographics, it's the unspoken but happening in plain sight right now, real-time threat of a more centralized state. What does that mean for our freedoms, our liberties, our thoughts, our currencies? Without getting into CBDC or Bitcoin versus gold, our liberties, and to Rick's point, which is extremely important, our understanding, the best asset is understanding something. And as we were talking about earlier, I'm from Michigan, Henry Ford State, but Henry Ford said many years ago, if the world understand how banks worked, fractional reserve banking, Federal Reserve, there'd be revolution. I think if the world, us, understood, if the major part of the population understood how bonds worked, or credit markets worked, or debt works at a sovereign level, we would be a far more savvy population. We would put more boots to the necks of our politicians who aren't being transparent. Failing that, my biggest fear is in demographics is centralization, of which the evidence around us is already too abundant.
All right, thank you, Matthew. And I know you probably got something to bolt onto that, Mark. So hold that thought. Prior to that, Grant, you mentioned Japan already, but anything else stand out? Not really an emerging nation, but anything else stand out globally? Nations that you're extra bullish on right now, and why?
Yeah, I think the demographic thing is a very important concept to understand, because the West is dying, and if you look at the monsoon region across North Africa, India, you will find Mexico and India are the easy, scary markets, right? People don't know much about them, but they're easy to get your head around. They're easy to understand. The India story is an obvious one. Based purely on population size. The Mexican one, it's close by, and everyone kind of understands Mexico. But you go to places like Ethiopia, go to places like Morocco. They're extraordinary countries, extraordinary populations. You just can't buy an ETF. And so it comes back to Rick's point about educating yourself and wanting to understand things. If you have the appetite to learn about new countries and new markets, and you have the appetite to dig into companies and stocks and find interesting companies doing interesting things that have extraordinary marketplaces and captive populations, there are some phenomenal places you can go and stocks out there that you can buy. But everything that we've been taught to do and we've been pushed into over the last 20 years is simple, simple, simple. How do I distill an idea, a country, down into a 3-letter ticker? Give me the ETF. Give me the India Biotech ETF. And that's worked because we've had zero cost of capital and we've had a rising tide lifting everything. I think we're going to go back to this point where, to Rick's point, education is going to be really important, and the world's going to look like a really scary and confusing place because you're going to have to go to places that you probably have to find out where they are on a map first. But if you make that effort, if you do the reading, if you understand the societies, the demographics, the political tensions in the region, you'll be able to find for yourself some extraordinary opportunities. They're just not going to be handed to you, and they're not going to come in the form of a 3-letter ETF.
I love that, Grant. Thank you. Mark, over to you.
Yeah, there's a lot to add into that. I think sort of going off of the comment of, the world changing in front of our eyes and deglobalization, I call it decentralization. And you kind of picked up on that, you call it centralization. So we have this massive centralizing force. We can see this now. But if you look back through thousands of years of history, it's like a pendulum that swings back and forth. Human nature takes things too far, and then we overcorrect and we take them too far the other way. And so we can see that we are in this massive pendulum swinging towards centralization. I believe that's peaking right around 2025. Obviously, you can see the WEF is still trying to hang on to that, but as we saw, a few speakers were there last week, just eviscerating them. Mm-hmm. John Roberts from Heritage Foundation, we saw Millier from Argentina, and they even admitted the whole theme was, I talked about this yesterday, the whole theme was how do we restore trust? They realized nobody trusts them anymore, nobody likes them anymore, it's all broken apart, and their goal, their options, their ideas were more censorship. If we can stop people from saying bad things, maybe we can get more trust. So that narrative is over, and I think globally it's decentralization. So then you have to kind of think about how that changes. I mean, just look at what's happening in the Red Sea and the Suez Canal right now. Ships are having to be rerouted around Africa, but that's another choke point. Now pirates can attack the ships right there. And I think the world continues to, unfortunately, de-evolve sort of that way. So when I think about India or Mexico, they're both great options. We know Apple's moving their manufacturing to India. You have a more sort of intelligent, educated, group of individuals, obviously a large population, a young population, but as the world breaks apart, I think Mexico is the natural, partner for the United States. From that perspective. So that's sort of the way I see it. I think centralization, I think things kind of get worse to the point that you've made. I mean, you mentioned a lot of these things, civil unrest and more censorship, and they'll do anything they can to hang on, but at the same time, there's each force has an equal and opposite reaction. On to the other point, I want to add on to what Rick said there, and actually everybody sort of echoed, is start with yourself first. We're all here throwing out a whole bunch of things, and you're over there in the audience thinking, oh, shoot, India, and now I got to go to Japan, and what about Mexico? I've never even been there before, and all of these things, but no, you don't, right? So first of all, pour into yourself first. If there's any investment you can make, it's yourself. There's 3 types of capital, and we all focus on the hardest one, and that's the financial capital. The more important capital is the relational capital, and then the mental capital. So all the deals, all the things I've ever got have been from people I know. Those are relationships that I have. And then I have to have the mental capacity, the skills to do something with that relationship. The money doesn't even matter. I lost an 8-figure portfolio and had to build it back up again. And I built it back up in record time because I still knew people and I still had skills. I didn't have the money. So focus on the mental aspect, focus on the skills, focus on the relationships. And then more importantly, what I want to say is, backstage before we went on, Rick was talking about how Berkshire Hathaway sort of runs the market and how you're going to bet against them. Warren Buffett has kind of always talked about diversification, diversification. Diversification is for ignorant people. Put all your eggs in one basket and watch the hell out of that basket. That's sort of what he said. And he has like this deal box where he only invests in his zone of genius. Rick told us what his zone of genius is, and he knows where he wants to stay in that lane. And I think each one of us should really focus on what is my interest, how can I become a genius in that zone, and just stay there. You don't need to be in India and Mexico. You don't need to be in Japan. Pick one of those. I like to say that the risk is in the investor, not the investment. I grew up surfing. I still surf all the time. I go to the North Shore of Hawaii and I surf on a regular basis. If I took Grant with me to Hawaii where the waves are 30 foot and I pulled him out in the water, he'd probably die. But yet there's people out there that are just playing all day and there's no problem because they've trained and they've sort of grown up that way. So the risk is in the investor. Educate yourself first. That's where the dividends lie. And I guess I'll sort of wrap it up with that.
Jay, can I just say,
Grant, please, yeah.
My inner 8-year-old child is so excited that in 2024, pirates are a threat. I love that. I just love that.
All right. I kind of love how this wrapped up, actually. If you were at yesterday morning's session, we opened up discussing the cycles of empire, beginning with the end, right? During the declining years, the sunset years of an empire. What do you see from an activity and a behavioral standpoint? You see money expansion, you see civil unrest, you see external competitors, all this stuff. But then we flip the script, and it's like, how do we emancipate ourselves from that cycle? Well, let's look at the emergent stage of that same empire. And what do we talk about? Good values, know where you're going, you don't get distracted by petty arguments, right? Hard work, boring, simple, but really, really effective because productivity builds wealth. And the third is reinvesting that wealth into education. And you see that in every emergent empire. That's all we have to do. That's the blueprints. I didn't prompt these guys. You went there on your own, but I really appreciate it because that's been the core message at this conference. We could keep on going, and I want to, but the clock is flashing red at me, which means my event insurance is about to expire. So we're going to wrap this up. I want you to give my panel a huge round of applause. Thank you so much.